completing liabilities, we will now focus on the final component on the balance sheet, equity. If we look at the balance sheet of Bata Shoe Company Limited, assets of Bata Shoe Company Limited are financed by both liabilities and equity. Remember the example I gave you. You bought a mini truck with 20 lakh taka. So your asset or your value of asset is 20 lakh taka. You invested 5 lakh taka and you took 15 lakh taka bank loan. So your investment, that means the 5 lakh taka, is your equity. Now, equity means what the owners own. In your case, you own 5 lakh taka. So your equity is 5 lakh taka. If we look at the accounting equation of balance sheet, assets is equal to liabilities plus equity. If we rephrase the equation, we can get the equity. Equity is equal to assets minus liability. So, equity represents the residual claim of the owners. The owners will be entitled for whatever is left after paying liabilities from the assets. Now the question is, who owns the full farm? In your case, which is a sole proprietorship, you are the owner. In the meantime, you are the managers. In case of partnership as well, owners and managers are the same person. Our focus of this course is on corporation. That corporations are different in terms of separation of ownership and management. Because in a corporation, owners do not really manage the farm. So owners and managers are different persons. So in a corporation, owners are the shareholder. Now the question is, in a corporation, owners do not really manage the farm. So investment of the shareholders is risky. So why should investors invest in a corporation? The reason is, shareholders of a corporation have got limited liability. Shareholders are not responsible for any liabilities beyond their investment, beyond their initial investment. For example, if a corporation or business becomes default, in this case, shareholders will not be responsible for all the liabilities of the business. This is why shareholders or investors invest in corporation. Now, probably you know that in a corporation, share is represented by a certificate which is known as a share certificate, and this represents the equity of the corporation. So, where we can get the market value of the equity. Shareholders of a corporation come and go because shareholders can easily sell their share if they want in the stock exchanges, and they can liquidate their investment. So shareholders come and go from the corporation. But corporations usually run for a long time. In this case, for a corporation, book value is not a good guide if you want to find out the value of assets, because book value depends on the historical cost of assets. Assets of a business or corporation could be purchased 20 years back, 10 years back, or even more. So, asset value, which is represented in the balance sheet of the corporation, does not really show the real picture or real value of the assets. Secondly, book value is not capable of capturing future opportunities of the business. Now, what should we go to get the market value of the equity? We can get the market value of the equity from the stock market. Using the formula, we can find out the market value of equity, which is market value of equity is equal to share price into number of shares. So, what do we get the share price? We can get the share price of the corporation from the stock exchange. In our context, there are two stock exchanges, Dhaka Stock Exchange and Chicago Stock Exchange. Companies which are listed in these stock exchanges, their share price are regularly updated, and to find out the share price of any stock which is listed in Dhaka and Chicago Stock Exchange, you can find the information from the market. So if you want to find out the market value of the equity, you need to look at what's the share price of this company in the stock exchange. In our next lecture, we'll focus on the first part of profit and loss statement, that's revenue.